A quarter-century chronicle of market catalysts, factual and foundational events shaping stock valuations, 2000 to 2025. Financial markets are punctuated by catalysts, pivotal events that compel investors to reassess a company's or sector's valuation. Over the past 25 years, catalysts have evolved from isolated corporate shocks to complex, interconnected phenomena driven by information speed, technological innovation, geopolitical risks, and climate liabilities. This report charts this evolution, integrating granular case studies with insights on how each catalyst drove stock price movements, distinguishing transient shocks from structural shifts. Transient shocks, e.g., earnings misses, CEO missteps, create volatility but rarely alter long-term trajectories. Structural shifts, e.g., transformative products, policy changes, redefine industries and market leadership. Key years include dot-com reckoning, 2000 to 2004. Speculative manias collapsed, forcing a focus on fundamentals. Transformational innovation, 2005 to 2009. Disruptive products like the iPhone emerged amid systemic financial fragility. Cloud and M&A dynamics, 2010 to 2015. SaaS models and strategic M&A reshaped valuations, while scandals highlighted risks. New catalysts, 2016 to 2019. Cybersecurity, climate risks, and governance became financially material. Unprecedented shocks and AI shift, 2020 to 2025. COVID-19, retail investor power, and AI redefined markets. In a world where a tweet or regulatory shift can move markets, this chronicle offers a roadmap for navigating future catalysts. 2. Introduction: the evolving anatomy of a market catalyst. A catalyst is an event or action that significantly alters a security's price or a market's trajectory by prompting investors to reevaluate risk, growth, or potential. Transient shocks cause sharp but temporary reactions. Structural shifts create durable change. The digital age has compressed reaction times, amplifying shocks via social media and 24-hour news cycles. The BP Deepwater Horizon spill, 2010, with a 55% stock drop in weeks, exemplifies this, contrasting with the slower fallout of Exxon Valdez, 1989. This report segments 2000 to 2025 into thematic eras, integrating case studies with insights on how catalysts drove stock price movements. 3. The dot-com reckoning and the scramble for fundamentals, 2000 to 2004. 2000. The dot-com bubble's burst saw the Nasdaq Composite plummet 80% from 5,132.52, March 2000, to 1,139, October 2002. Case study: Pets.com and the dot-com crash. Pets.com, fueled by venture capital and a sock puppet mascot, went public in February 2000 at $11 per share. Its focus on brand over profitability led to collapse by November, with shares trading for pennies. The lack of a sustainable business model shattered investor confidence, triggering a rapid stock collapse. Case study: AOL-Time Warner merger. The $350 billion AOL-Time Warner merger, announced January 2000, promised media synergy but led to a $99 billion write-down in 2002 due to cultural clashes and the dot-com bust. The stock halved, highlighting risks of over-optimistic M&A. Overhyped synergies and the bursting bubble eroded investor trust, driving a sharp decline in the merged entity's stock. Amazon's pivot to profitability in 2000, after falling from $106 to under $7, saw its stock rise 30% by year-end, signaling resilience. The strategic focus on operational efficiency restored investor faith, fueling a stock recovery. 2001. Case study: Enron and WorldCom scandals. Enron's stock fell from $90 to under $1 in 2001 after accounting fraud exposed hidden debt. WorldCom's 2002 $11 billion fraud led to the largest U.S. bankruptcy at the time. These triggered the Sarbanes-Oxley Act, 2002, mandating stricter oversight, yet governance risks persist. Revelations of systemic fraud destroyed investor trust, causing precipitous stock declines. eBay thrived, with 74% revenue growth and 152% cash flow growth, its stock rising 40%. Strong fundamentals and network-driven growth boosted investor confidence, driving stock appreciation. See 2002. Case study: Global Crossing bankruptcy. Global Crossing's overexpansion in fiber optic networks led to bankruptcy in 2002, with stock falling from $60, 1999, to under $1. This underscored risks in capital-intensive sectors, amplifying the telecom sector's collapse. Over-leveraged infrastructure bets overwhelmed investor sentiment, leading to a near-total stock value wipeout. Paychex's stock rose 25% due to stable demand and recurring revenue. Consistent demand and predictable cash flows reassured investors, supporting stock gains. Amazon's one-click patent and Apple's iTunes launch drove market cap growth. Innovative intellectual property enhanced investor optimism, boosting stock valuations. D2003. A recovering economy and corporate profits spurred a bull run, lifting most sectors. 2004. Case study, Google IPO. Google's August 2004 IPO at $85 per share doubled to $172 by 2005, driven by its scalable ad model. This showed how innovative monetization created market leaders. The scalable search and advertising model fueled investor enthusiasm, driving rapid stock appreciation. The S&P 500 saw positive returns across all sectors. 4. From systemic crisis to transformational innovation, 2005 to 2009. 2005. Case study, Hurricane Katrina and insurance stocks. Hurricane Katrina's $60 billion in insured losses cut Allstate stock from $62 to $54 and Chubb's by 10 to 15%. Recovery by 2007 via premium adjustments showed insurers' adaptability. Catastrophic losses raised risk perceptions, driving short-term stock declines before operational adjustments restored confidence. Nvidia stock rose due to its Xbox 360 graphics chip contract. Securing a high-profile gaming contract signaled growth potential, boosting investor demand and stock price. Beat 2006. Case study, Toyota's Prius and the hybrid surge. Toyota's Prius, fueled by high oil prices and environmental awareness, drove a 40% stock rise from 2005 to 2006, highlighting sustainability's impact on traditional industries. Growing demand for eco-friendly vehicles aligned with societal shifts, driving investor optimism and stock gains. OfficeMax and Big Lots gained from turnaround plans and buybacks. Cost-cutting and shareholder-friendly policies restored investor trust, supporting stock price increases. C. 2007. Apple's iPhone launch redefined mobile computing, with its stock surging 60% from $122 to $200. The revolutionary iPhone expanded market potential, fueling investor enthusiasm and stock growth. Google's stock rose 50% via search and AdWords improvements. Iterative product enhancements strengthened revenue streams, boosting investor confidence and stock value. Exelixis gained from clinical trial milestones. Positive drug trial data signaled future revenue potential, driving stock appreciation. D2008. Case study, Volkswagen short squeeze. Porsche's derivatives-based stake in Volkswagen caused a 300% stock spike in October 2008, briefly valuing VW at €300 billion. Short sellers lost billions, showing how market mechanics can defy fundamentals. Derivatives-driven scarcity of shares forced short sellers to cover, skyrocketing the stock price. Case study, the financial crisis. Lehman Brothers bankruptcy in September 2008 erased $10 trillion in global equity, with the S&P 500 falling 57% from 2007 to 2009. Bailouts stabilized banks and automakers. Systemic financial collapse shattered investor confidence, triggering widespread stock declines. Walmart's stock grew 20%, thriving as a defensive sector. Budget-conscious consumer behavior during the crisis bolstered investor demand, supporting stock resilience. 2009. Case study, General Motors bankruptcy. GM's 2009 bankruptcy, with $82 billion in debt, wiped out shareholders as stock fell to zero. A government-led restructuring enabled relisting in 2010, but highlighted legacy industry risks. Unsustainable debt and declining sales crushed investor trust, obliterating stock value. Intuitive Surgical's Da Vinci system drove a 70% stock rise, with 40% Q4 revenue growth. Adoption of innovative surgical technology signaled strong growth, boosting investor confidence and stock price. V. Disruption, mergers, and the rise of cloud, 2010 to 2015. 2010. Salesforce's SaaS model drove a 50% stock rise. The scalable subscription model signaled predictable revenue, fueling investor enthusiasm and stock growth. The BP Deepwater Horizon spill cut BP's stock 55%, $60 to $27, amplified by social media. Environmental disaster and public outrage eroded investor trust, triggering a sharp stock decline. B. 2011. Disney's $4 billion Marvel acquisition, 2009, paid off with The Avengers, 2012, grossing $1.5 billion, boosting Disney stock 40%. Content synergies from strategic M&A drove investor optimism, lifting stock value. Case study, Hewlett-Packard's Autonomy acquisition. HP's $10.3 billion Autonomy buy led to an $8.8 billion write-down in 2012 after accounting issues, with stock falling 25%, highlighting M&A risks. Accounting irregularities and overvaluation shattered investor confidence, driving a significant stock drop. Case study, BlackBerry's fall. BlackBerry's stock fell 75%, $70 to $17, from 2011 to 2012, failing to compete with Apple and Android ecosystems, showing disruption's brutality. Failure to adapt to new ecosystems eroded market share and investor trust, triggering a steep stock decline. Amazon's Kindle Fire launch boosted its stock 30%. Ecosystem expansion drove content sales, enhancing investor confidence and stock price. See 2012. Case study, Facebook IPO. Facebook's May 2012 IPO at $38 fell to $17 due to mobile revenue concerns but tripled by 2014 as mobile ads succeeded, showing execution's importance. Initial mobile revenue fears depressed the stock, but successful execution restored investor confidence, driving recovery. D. 2013. Netflix's original content pivot, House of Cards, tripled its stock, $50 to $150, from 2013 to 2015, with subscribers growing from 35.6 million to 62.7 million. The shift to original content signaled market leadership, boosting investor demand and stock value. Case study, Gilead Sciences and Sovaldi. Sovaldi's 90% hepatitis C cure rate generated $10.3 billion in first-year sales, driving Gilead stock from $40 to $100. Breakthrough drug innovation signaled massive revenue potential, driving stock appreciation. Tesla's Model S pushed its stock up 300%. Innovative EV performance captured investor enthusiasm, fueling rapid stock growth. 2014. Alibaba's $25 billion IPO saw a 38% stock surge, signaling global leadership. The massive IPO reflected global market potential, driving investor demand and stock price. Albemarle's stock rose after acquiring Rockwood Holdings. Strategic business focus signaled profitability, boosting investor confidence and stock value. 2015. Case study, Volkswagen Dieselgate. Volkswagen's emissions scandal led to a 40% stock drop, €250 to €150, and $30 billion in fines, forcing an EV pivot. Regulatory violations and reputational damage eroded investor trust, triggering a sharp stock decline. Case study, PayPal spin-off. eBay's PayPal spin-off unlocked $45 billion, with PayPal stock rising 60% in its first year. The spin-off released trapped value, boosting investor optimism and stock price. Case study, Theranos fraud revelation. Theranos' $9 billion valuation collapsed in 2015 after its technology was exposed as fraudulent, shaking biotech confidence. Fraud revelations destroyed investor trust, obliterating valuation. Microsoft's Azure pivot under Nadella drove a 20% stock rise. The cloud-focused reinvention signaled growth potential, lifting investor confidence and stock value. 6. New catalysts for a new market. Data, climate, and governance, 2016 to 2019. 2016. CRISPR Therapeutics IPO boosted the gene editing sector. Innovative technology signaled future potential, driving investor enthusiasm and stock gains. NVIDIA's GPUs for AI drove a 200% stock rise. Early AI adoption positioned NVIDIA as a market leader, fueling investor demand and stock appreciation. B. 2017. Case study, Equifax data breach. Equifax's breach of 147 million records cut its stock 35%, $142 to $92. Cybersecurity improvements enabled recovery by 2019. The data breach eroded investor trust, triggering a sharp stock drop, though operational fixes later restored confidence. Shopify stock rose 120% via e-commerce growth. Empowering small businesses signaled scalable growth, boosting investor optimism and stock price. See 2018. Case study, Tesla and CEO governance. Musk's funding secured tweet cut Tesla stock 50%, $370 to $180. Yet its $1 trillion valuation by 2021 showed innovation's resilience. The tweet raised governance concerns, triggering a sell-off, but innovation later restored investor confidence. Case study, US-China trade war and Apple. Tariffs cut Apple's stock 30%, $232 to $150 in 2018, but supplier diversification drove recovery. Supply chain disruptions raised risk perceptions, depressing the stock, though adaptability restored value. Boeing's 737 MAX crashes erased 25% of its stock, $440 to $330. Safety lapses shattered investor trust, leading to a significant stock decline. 2019. Case study, PG&E and wildfire liabilities. PG&E's $30 billion wildfire liabilities led to a 90% stock drop in 2019 bankruptcy, highlighting climate risks. Massive liabilities signaled financial instability, triggering a near-total stock collapse. Case study, Boeing 737 MAX crashes. Boeing's safety lapses lingered, with repercussions into 2021. Ongoing safety concerns prolonged investor skepticism, depressing stock value. Zoom's IPO saw a 70% stock rise, foreshadowing 2020 gains. Remote work potential signaled growth, boosting investor demand and stock price. 7. Unprecedented shocks in the AI paradigm shift, 2020 to 2025. 2020. Case study, Zoom and remote work. Zoom stock surged 400%, $68 to $340, as remote work became essential, while Carnival Cruise Lines fell 70%, $50 to $15. Surging demand for remote solutions fueled investor enthusiasm, driving Zoom's stock up, while travel restrictions crushed Carnival's value. Case study, Moderna and vaccine innovation. Moderna's mRNA vaccine drove its stock from $20 to $500 by 2021, though post-vaccine declines showed limits of one-off catalysts. Vaccine success signaled biotech leadership, boosting stock value, but waning demand later tempered gains. Tesla's S&P 500 inclusion drove a 700% stock rise. Index inclusion triggered institutional buying, fueling massive stock appreciation. 2021. Case study, GameStop in the meme stock era. Reddit's Wall Street bets drove GameStop from $17 to $500, costing hedge funds billions, showing retail sentiment's power. Social media-driven retail buying overwhelmed fundamentals, skyrocketing the stock price. Rivian's IPO surged 50%, valuing it above legacy automakers. EV sector enthusiasm drove investor demand, boosting stock value. Case study, Peloton's post-pandemic slump. Peloton stock fell 80%, $171 to $30, from 2020 to 2022 as gyms reopened, showing transient shocks tied to consumer shifts. Reverting consumer behavior reduced demand, triggering a steep stock decline. See 2022. Case study, Meta's $232 billion wipeout. Meta's February 2022 earnings miss-erased $232 billion, dropping from $323 to $220, while Amazon gained $190 billion on cloud strength. Disappointing metaverse progress eroded investor confidence, triggering a massive sell-off. Case study, Inflation Reduction Act. The IRA doubled First Solar's stock, $80 to $160, via subsidies. Green energy subsidies signaled growth potential, driving stock appreciation. Shopify's stock rebounded 40% via e-commerce resilience. Operational streamlining restored investor trust, boosting stock recovery. 2023. Case study, NVIDIA and the AI boom. NVIDIA's market cap hit $4 trillion by 2025, with stock rising from $120 to $500, driven by AI GPU demand. AI infrastructure leadership fueled investor demand, driving unprecedented stock growth. Palantir's stock rose 100% via AI-driven contracts. Expanded AI contracts signaled revenue growth, boosting investor confidence and stock price. 2024. Case study, TSMC and Taiwan tensions. TSMC stock dipped 10% amid Taiwan Strait tensions, highlighting geopolitical risks. Geopolitical uncertainty raised supply chain risks, depressing stock value. Case study, Amazon supply chain resilience. Amazon stock rose 25%, $120 to $150, from 2023 to 2024 via logistics investments. Operational resilience mitigated macro risks, boosting investor confidence and stock price. On semiconductor and Snowflake rose due to EV and AI demand. Demand for critical tech infrastructure signaled growth, driving stock appreciation. 2025. Case study, Treasury Clean Energy Guidance. The U.S. Treasury's 2025 tax credit clarification boosted First Solar 9%, $220 to $240. Regulatory clarity reduced uncertainty, driving investor demand and stock gains. Case study, Lockheed Martin and defense stability. Lockheed Martin's $180 million F-35 contracts drove a 15% stock rise. Stable government contracts signaled reliability, boosting investor confidence and stock price. Case study, Meta's metaverse gamble. Meta's Reality Labs lost $20 billion, lagging peers despite ad revenue. Metaverse losses fueled investor skepticism, depressing stock performance. Eli Lilly's Mounjaro approval drove a 30% stock rise. Expanded drug approval signaled revenue growth, boosting investor optimism and stock value. 8. Conclusion, distinguishing transient shocks from structural shifts. Catalysts have evolved, shaped by technology, policy, and behavior. Frauds, Enron, Theranos, Dieselgate, cause swift, often permanent damage. Innovation, iPhone, Sovaldi, NVIDIA GPUs, drives durable growth. Policy, Sarbanes-Oxley IRA Treasury guidance, reshapes industries. Geopolitical and climate risks, TSMC, PG&E, increasingly drive swings. Information speed amplifies crises, BP spill, and rallies, GameStop. The investor's challenge is distinguishing transient shocks from structural shifts to navigate tomorrow's markets.